American Eagle Outfitters, or AEO, just dropped its third quarter earnings for fiscal 2025.
And the market went wild.
Completely. The stock shot up over 11% in just one day.
Yeah, and a jump like that isn't just about a simple beat. It's about a fundamental surprise. So today, let's break down what actually drove that performance.
And what their huge guidance increase tells us about shoppers heading into the holidays.
Yeah.
Okay, so let's dig into the hard numbers first, the ones that really cause that initial reaction.
Right, the scorecard. First up, earnings per share, or EPS, it came in at 53 cents.
And analysts were expecting what? Something closer to 43 cents.
Exactly. So that's a 10-cent beat, which is a really substantial margin. It immediately tells you something is going right on the efficiency side.
And it was backed by some serious sales volume.
Oh, absolutely. Total revenue hit a record $1.36 billion for the quarter.
Which blew past the consensus of $1.32 billion. That's a 6% increase over last year.
A very healthy increase. And that top-line growth flows right down to profit. Operating profit was up to $113 million.
Compared to about $106 million last year.
Mm-hmm. And the big one, total comparable sales, they were up 4%.
And, you know, a 4% comp is pretty solid for a retailer like this today. But that number, it almost hides the real story.
It really does. Because this is a classic two-engine strategy in action.
The classic tale of two brands.
Yes. And if you're preparing for a meeting on AEO, you have to get this. One brand is doing well and the other is just on fire.
And that's where this gets really interesting. Aerie is still the undisputed star of the show.
It's not even close. Aerie delivered double-digit comparable sales growth of 11%.
11%. I mean, in this retail environment, that's just exceptional.
It is. That brought in nearly $462 million in revenue just for Aerie. The brand is just perfectly positioned for where the culture is right now, you know, with comfort and authenticity.
Meanwhile, the main American Eagle brand, it brought in most of the revenue, around $854 million.
But the growth was much slower.
Much slower. A positive but very modest 1% comp increase. The difference is just stark.
It is. And the CEO, Jay Schottenstein, he was very clear this wasn't just luck. He credited, and I'm quoting here, decisive steps taken from merchandising to marketing to operations.
So my question is this. If the main AE brand is only growing at 1%, is this a real company-wide turnaround? Or is Aerie just covering for some underlying weakness?
That's the critical question, right? But the signs point to management knowing this and using Aerie's momentum to invest everywhere else.
Okay.
And the CEO said this momentum kept going right into Q4. He mentioned a record-breaking Thanksgiving weekend.
And he specifically called out Aerie, but also something else.
Right. He highlighted outstanding growth at Aerie and offline. So this isn't just an online story. Their physical stores are a huge driver for that brand's success.
So you've got this huge jump in sales, operational success. You'd think margins would be expanding.
You would, but this is where we have to talk about a major external pressure.
Tariffs.
Exactly. This is a really important detail in their financials. So gross profit was up 5% to $552 million. That's great.
But the margin itself?
The gross margin actually went down a bit. It slipped by 40 basis points from 40.9% last year to 40.5%.
And that's all because of the tariff headwind.
Yeah.
How big was that impact for Q3?
It was significant. The net tariff impact was $20 million.
$20 million.
Yeah. And that single line item accounted for 150 basis points of pressure on their gross margin. So think about it. If you took that away, their margins would have actually gone up substantially.
So the core business was actually doing its job, managing costs like markdowns, but this external tariff issue was just too big to absorb without a hit.
That's precisely it. They actually did a great job offsetting higher markdowns with better freight costs. They were also leveraging their occupancy and warehouse costs, which is a great sign of efficiency.
Now, on the expense side, SG&A, selling, general, and admin expenses, they were up 10%.
Right.
And that pushed the SG&A rate to over 28% of revenue. With margin pressure from tariffs, should we be worried about that higher spending?
Well, I think it was a very intentional choice. They said that increase was mainly driven by planned investments in advertising.
Oh, so they're leading into the momentum?
Exactly. They're choosing to spend now, taking a small hit on current profit because they see a huge return on that spend, especially for driving Aerie. It's a signal of confidence that their marketing is working.
And that confidence really shines through when you get to the biggest takeaway for the market.
Yeah.
The massive shift in their forward guidance.
This is why the stock popped. Management basically told Wall Street that Q3 beat wasn't a fluke, it's the new normal. I mean, just look at the size of the Q4 guidance increase.
Their old forecast for Q4 operating income was, what, 125 to 130 million?
It was, and they raised that sharply to a new range of $155 to $160 million.
Can you frame how big of a jump that really is?
It's an astonishing boost. At the midpoint, that's a 23 to 24% increase. To make a revision that big this late in the year means they are seeing incredible sustained demand right now.
And the sales guidance backs that up.
It does. Comparable sales guidance was raised from low single digits,
To 8 to 9% growth.
8 to 9%. That signals huge consumer enthusiasm right in the middle of the most important shopping season. And of course, that let them raise the outlook for the entire fiscal year.
Right. So full year adjusted operating income, previously 255 to 265 million, is now up to 303 to 308 million.
That's almost a $50 million boost at the high end. The momentum is just undeniable. And full-year comps are now expected to be in the low single digits, up from flat before.
But we can't forget the other number they gave us for Q4.
The tariff impact.
A projected $50 million hit just for the fourth quarter alone.
Yes. And for the whole year, the total impact is expected to be around $70 million.
So let me get this straight. Their business is performing so well that it can absorb a $70 million headwind from trade policy.
And still raise profit expectations by almost $50 million.
That's incredible.
It shows they have immense pricing power, especially with Aerie. That lets them pass some of that cost on without killing demand.
So what are they doing long-term about that? Are they just going to eat that $70 million cost every year?
Well, for now, they're relying on that strong demand to absorb it. But no company wants that kind of anchor long term. You have to assume they're working hard to diversify their sourcing and supply chain. But that stuff takes time. For now, the story is that they can handle it.
Okay, let's look at the balance sheet. What's supporting this aggressive guidance? First, inventory. It was up 11% to 891 million. Is that a red flag?
You know, normally it might be, but given the context, it feels like a healthy strategic move.
Because they're expecting that huge sales jump.
Exactly. The units were up 8%, and they're forecasting an 8 to 9% comp increase for Q4. They're stocking up because they're confident the demand is real. They don't want to have empty shelves and miss out on sales.
And that confidence also shows up in their capital investment, right?
Absolutely. $70 million in CapEx for Q3, with about $275 million expected for the whole year. These aren't just maintenance costs. These are growth investments.
Probably for stores, technology.
Things that support that accelerating Aerie brand. It shows they're focused on the future, not just managing the present.
And what about shareholder returns?
Still very strong. They paid out $21 million in dividends in Q3, bringing the year-to-date total to $64 million.
And they also did share repurchases earlier in the year.
That's right, $231 million, all in the first half. So they're balancing heavy investment with returning cash to shareholders. It's a solid strategy.
So finally, for anyone listening, it's always important to look at the risks, even when things look this good. What does AEO themselves call out?
Well, you have the standard retail risks, being wrong about customer demand, rising material costs. But the one that stands out, given our conversation, is trade risk.
They mention it specifically.
They explicitly cite the impact that import tariffs have had and may continue to have on our product costs. With a $70 million projection for the year, that's not a theoretical risk. It's a very real material burden.
Which links right back to Aerie. Aerie's success isn't just driving growth.
It's also their primary shield against that financial damage from tariffs. Any slowdown in that Aerie momentum would make that tariff expense much, much more painful.
So when you put it all together, what do we have? AEO had a fantastic Q3, almost entirely fueled by Aerie's double-digit growth.
And, just really solid management execution. They saw the trend and they capitalized on it.
And that success let them massively raise their guidance for the holiday season, even while dealing with a huge, nearly $70 million headwind from tariffs.
It's really a textbook case of a multi-brand retailer playing to its strengths. They've shown they have pricing power and operational skill. That advertising spend is clearly working. They're just firing on all cylinders.
But those cylinders are pretty much all inside the Aerie engine.
Which brings us to a final thought for you to consider. Given Aerie's incredible performance and all the investment they're pouring into it, How much more runway does that brand have before it starts to saturate its main market?
When does the super fast growth have to slow down?
Exactly. When do they have to find the next Aerie to keep delivering this kind of surprise to the market? It's the challenge every high growth story eventually faces.
A challenge for another day, it seems. For now, the momentum is clearly on their side. That's our look at American Eagle Outfitters. Thanks for tuning in.